Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities and historical data, all delivered via API, XML and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to this week's edition of Econoday Unplugged. It's Wednesday, the 27th of March 2019. Mark Pender is in the US, ranked 19th in the 7th edition of the World Happiness Report released just last week. I'm Jeremy Hawk.
Is that me or the US?
This is you. You are now ranked.
Wow, I knew I was happy, but
this is you. You are representing the US, of course.
Oh, okay.
19th in the World Happiness Report. And I'm Jeremy Hawkins here in the UK, and we're ranked 4 places higher at a lofty 15th, although presumably poised to nosedive in the wake of the ongoing Brexit chaos. Okay, so then, what do we got? Well, last week we saw UK Parliament in virtual meltdown as everyone blamed everybody else for the failure to sort out Brexit, which of course was supposed to happen this Friday, but now won't. Stateside, the Fed has apparently completed a remarkably quick dovish U-turn, and there's plenty of red ink about too, as US government borrowing hit a new record high in February, and the fourth quarter current account deficit was the largest in a decade. So, Mark Pender, does this mean that the next move in Fed funds could be down, and should we be worried about all this borrowing?
Well, let's first talk about the rate outlook. It's too close to call right now. If the indicators go as they've been trending, then I think it is more likely that we would have a rate cut than a rate hike. But I think that is well down the road. The Fed said last week that it's not going to raise rates this year. But, you have to take that a little, even though they're very unlikely to raise rates, you have to take, or change rates, you have to take all that with a grain of salt, I think, because of we're still at the beginning of the year and events can change so quickly. And of course, you have the exogenous risk, especially of Brexit. Whether or not the Treasury budget is the government deficit or the country's current account deficit, which includes the trade deficit, is an immediate risk. It's hard. It apparently is not, even though we had the Treasury budget is a whopping 5 months in the fiscal year, came out last Friday, $544.2 billion. That's only 5 months. And that's 39% deeper than the same period last year. And if you look at the graph, it is really a large increase in the deficit. And what that is going to do, that will limit the government's ability or fiscal ability to stimulate the economy if we need to. And that is one reason why the Fed is seeing a little bit of a slowing for this year. The trade deficit, we had number out this morning, and it actually came in a little bit better than actually substantially better than expected. And but that was against a very deep deficit in December. So actually the outlook right now for the first quarter looks a little bit positive. It was still $51.1 billion. You're talking about all this massive amount of money flowing out of the United States. It's pretty incredible. But that seems to have been, how it's been done here for a couple of generations. And if you look at the current account deficit relative to GDP, it's really not that extraordinary. It's 2.6% right now, and that's up from 2.5%. The incredible output of this economy in goods, and especially, of course, in services and foreign demand for services, it offers us or gives the U.S. a pretty solid cushion for continued growth. It'll depend on the consumer. Right now, we're at a pivot, I think. We had a really abrupt slowing in non-farm payroll in February, only 20,000. And we did have a bit of a crack in consumer spending, even though it seemed to have improved a little bit in January. And consumer confidence, we had that out yesterday, and that wasn't so terrific. And the Conference Board's samples assessment of the labor market turned a little bit sour. So that's not pointing to much improvement for the March employment report. If we do get next week a low reading in the employment report, which is not expected, that could change everything, and we could be talking about an eventual rate cut. But I think that would be getting ahead of the game. But Brexit is unbelievably such this perplexing risk, and it just doesn't seem to go away, and it just seems to get more and more significant, and it could be the make or break for the 2019 economy. So now, tell us what is your hunch at what the resolution will be?
Oh, straight in with the hard questions, though. Well, I suppose one thing, just since we're just talking about deficits, is interesting. You say, really, I suppose when we look at the budget deficit in the States and the current account deficit and the impact upon bond yields and the dollar, really, it seems to be virtually nothing. And certainly, I guess if we go back sort of 20 years or so when I first started in this business, the combination of a big current account deficit and a big budget deficit was really quite negative for a currency. But in terms of Brexit, now one of the issues, of course, for the UK is the pound. And the pound's obviously intricately linked to Brexit at the moment. But let's just assume for the moment that this all goes pear-shaped and we end up with no deal. Well, he talked about the state side. I think we said, deficit to GDP ratio is only about 2.6%.
2.6.
2.6%. Well, if we look at the equivalent for the UK, the current account to GDP deficit here is running around about 4.5% to 5% at the moment. So that's around pretty serious levels, and it does kind of suggest if we don't have some sort of interest rate environment which is supportive of capital inflows into the UK, this could still be a medium-term negative as far as the pound's concerned. So with regards to Brexit, where do we stand now? The obvious question is, I think anyone who pretends to have any idea how this is going to pan out is talking out the top of their head, because no one knows. As we currently stand, indeed, as we speak, there will be now, as a result of the EU leaders summit last week, the UK's been given 2 Brexit days. So it won't be this Friday as it should have been. But if Mrs May can get proposals through the UK Parliament, which still seems very unlikely. Indeed, she was supposed to be trying again today, but decided to pull the vote because she didn't think she'd get a majority, which is almost certainly true. But if she were to get that through, then Brexit Day will be on May the 22nd. And really, that would just leave long enough for the technicalities to be addressed before leaving. If, however, she can't get it through, then under what the EU's saying at the moment, Brexit Day will be on the 12th of April. And at that point, the UK would just have to set out what it intends to do, or indeed leave without a deal. Now, the big question at the moment, of course, is can we get any kind of parliamentary majority in favour of any kind of Brexit solution? So as we talk on Wednesday the 27th, there will be a series of so-called indicative votes going through the House of Commons later on this evening, with a view to trying to find out exactly what politicians might be prepared to go for. So there will be a number of different options. We don't actually know what will be on the ballot papers yet, but we're going to see such things as Mrs May's deal, probably leaving the EU without a deal, extending Article 50 beyond what's currently offered, a close relationship with the EU, revoking Article 50, so binning Brexit altogether. There's probably about half a dozen or so different options upon which the MPs can vote. That is expected to produce some kind of narrowing in terms of where we go this evening, and potentially a final vote on the outcome next Monday. Now, what that is going to look like, I really don't know. But it seems to me that realistically, now Parliament is gradually gaining some kind of control over the process and taking it away from the hands of Mrs May, that since Parliament by and large is sort of pro-EU, or at least remaining, I think the odds are in favour of some kind of softer Brexit than we've been looking at for some while. Certainly the idea of a no-deal Brexit seems to be off the cards, though we clearly can't rule it out altogether. So there ought to be sort of marginally good news for the pound. Now, one other thing I should quickly mention is that there is a meeting taking place today at which Mrs May, as the speculation is, will be announcing a possible departure date for her from her position as Prime Minister. And the bargaining point is that one of the problems for a lot of people actually signing off on her deal in UK Parliament is Mrs May. And I think if they can get rid of her, they may be prepared to actually support her deal. So she would prepare.
Do you think the pound would rise on the announcement?
I think it would. As we talked in the past, and we're looking at sort of sterling euro as kind of the benchmark indicator of how things are going as far as the FX market's concerned. Well, as we talked, sterling euro is running at about 1.1750, which is pretty strong in the context of still what is a lot of uncertainty. So I think there is clearly some good news priced into it, but because uncertainty is still so high, I think anything which suggests that we're going to get a deal in the shape that's currently proposed by Mrs May, or better still for financial markets, something closer, something deeper, a deeper relationship with the European Union, then that's going to be taken positively. So I think there's a chance even from these levels that we'll see sterling spike higher.
How is the bond market doing in Europe? We had a huge rush into the bond market in the U.S. on the Fed announcement winding down quantitative easing. That's going to be raising demand ultimately for bonds or relative to the Fed's balance sheet, at least. And so how did that? And so we had a sharp decrease in rates here, and a near inversion in the 2 and 10-year Treasury curve. How's the bond market reacting to Brexit and to the U.S. FOMC?
Well, certainly European bonds were delighted by the FOMC's announcement. I think they didn't expect anything too much to come out of that particular meeting. In the end, I think the general view was that, well, the FOMC seems perhaps a good deal more dovish than originally expected. So it's prompted a fairly decent rally right across Europe, and that's both in terms of the sort of the safe haven, the core members such as Germany, and the typically more peripheral Eurozone countries like Italy. So as we speak, on the German benchmark 10-year benchmark Bund is yielding minus 0.04%. So we're back into negative territory here. Now, I think part of this certainly is due to the FOMC and perhaps some reappraisals about.
Jeremy, I have one question or a question regarding emerging markets now. Now that interest rates are down, and you were talking about periphery bonds in Europe, do you think that there'll be you will see stronger demand for a Spanish, Portuguese debt?
Yes, I think certainly we're starting to see that already. I think one of the big worries always for the the less well-developed economies, be it in Europe or around the rest of the world, is the combination of higher US interest rates and a strong dollar. Well, it now seems that from what you're saying, it looks as if US rates perhaps won't be going up, perhaps at all, or certainly not as sharp as originally expected. And the dollar is not overly strong. I mean, it's doing okay, but it's not causing the emergence any problems. So I think we're moving towards the kind of area in which, well, let's look around the world. Interest rates are very low. Where can we make any money? So at least if you think about putting your money into, let's say, the Italian BTP, so their benchmark bond market, we're talking there about yields around about 2.4% or so, something like that. That still looks pretty attractive compared to the likes of the German Bund market, which is currently yielding minus 0.4%. So I think investors have been burnt before, but I think if we do become more confident about not a big global recession, because then we've got all sorts of problems, but if we're talking about a slowdown in growth and generally low levels of industrialized interest rates, then yes, investors are going to start looking at much more favorable those countries which give a bigger bang for your buck.
How do you, and this might be our last question, but how do you would rank the global central bank movement now toward easier conditions. Were they? It corresponded with. It seemed to move pretty quickly. The decline in fourth quarter growth, the general global growth, and then what appears to be perhaps steady but at a lower rate growth generally in the first quarter. Do you think that they pivoted too on time, or did they were they too hawkish for too long? And caused that? How would you rate it? Because it all seems to have been a common global thread.
I know. Yeah, I mean, I kind of agree with you. I suppose the main thing to say at the moment for a lot of the industrialized central banks, we haven't actually seen any interest rate cuts coming through per se. I know we've seen some out of the likes of the RBI, so the Reserve Bank of India, or that could be perhaps put down to politics more than anything else. But we look around more generally for those banks which have, they've shifted their sort of their bias rather than on changing rates. So the Bank of England, by all means, still has a tightening bias, but it's extremely loose and contingent upon a favourable Brexit. The ECB is now operating with at least downside risks as far as its economic forecasts are concerned, and they've already been revised down anyway. And even those countries, perhaps like Australia and New Zealand, which had been doing pretty well, well, Australia now seems to have ruled out another hike in interest rates. And just yesterday, we saw the Reserve Bank of New Zealand dropping its tightening bias in favour of neutrality. So it looks as if, generally speaking, rather than the chance of interest rates going up, going completely out the water, it's very much been ratcheted down to the extent that perhaps the next move could be down, but not necessarily so.
But did they anticipate the economic slowdown? Were they too slow? And
I think it's difficult to say. I think you can pick on individual central banks. I think when you look at the European Central Bank, my personal feeling, indeed, and we talked about it for a while now, that the Eurozone economy, which according to the ECB, let's go back a year ago now, it started off the beginning of 2018 on a pretty solid footing. Then we had a slowdown, and the expectation from the ECB was it's only temporary, second half of the year is going to look good. Well, the second half year didn't look good. We saw no bounce back in GDP growth whatsoever. And indeed, from what we know from the sort of the forward-looking indicators, it seems first quarter Eurozone GDP is going to struggle to be much above zero, I suspect, probably about 0.1, 0.2% on a quarterly basis. So I think it's fair to say that they've been somewhat behind the curve. And perhaps investors haven't been too impressed with that. And that's one of the reasons why we're seeing the euro struggling. For some of the other central banks, I think we're talking about it last week or the week before, there appears to have been a lot of statistical noise within the data themselves, which has made it quite hard to determine, well, is this a proper slowdown? Or is it the case if we start pulling the trigger now, we've moved too early? So I think, being a central banker and making policy is never going to be that easy. I think at least they appear to be reacting. Perhaps they should have done more. I mean, certainly, let's say from your side, if we see the US slowing really sharply now, then the global economy is going to have some big problems.
Well, we can't forget that it was December that the Fed raised rates. It hasn't been that long,
So the turnaround there has been remarkably quick. Yeah. Okay. Well, on that note, I guess we should probably get somewhere towards finishing. I think someone said that today was our 151st podcast.
Wow.
So to anyone out there in podcast land who's managed to sit through all this little lot, congratulations on the stamina. Do try bottling it because you can make a fortune. Anyway, Mark and myself will be back for number 152 next week. Thanks for listening.
In response to regulatory requirements under MiFID II, Econoday has launched the first and only third-party sovereign debt auction database that provides pre- and post-trade transparency. Our machine-readable database tracks historical and immediate auction data of 10 countries, averaging roughly 1.7 trillion euros spread over 700 auctions each year. Our specialists cover cross-country comparisons of rates, spreads, coverage and volumes in trading decisions. Go to www.econoday.com and follow @Econoday on Twitter to learn more.